We've just entered into the second most overvalued stock market in history on an inflationary adjusted basis after a sweeping recovery of nearly 30% since the market lows of April. Now that's a statement that I didn't expect to make when we were staring down the barrel of a bear market at the end of Q2, but here we are. I guess the question that's now on investors' minds is, with the market at all-time highs and overvalued to an extent, is now a good or a bad time to invest? Well, today we're going to assess the current state of the US stock market, and we're also going to discuss, based on some research that I've found, how to prevent portfolio underperformance if in the event that a dreaded stock market crash was to occur. Quick disclaimer though, this video is for educational purposes only and is not financial advice. Nothing within this video is an investment recommendation. Always do your own research, and when you're investing, your capital is at risk. Warren Buffett has most recently sold 2 of his 3 biggest holdings, with 46 million shares in total across Apple and Bank of America. And with recent reports showing that he's sitting on an absolute mountain of cash, it's certainly going to raise some eyebrows amongst the investing community. After all, with Warren Buffett being a net seller based on his latest 13F filing, it kind of makes us feel like, does he know something that we don't? Especially as the Buffett indicator, which is a measure of GDP to stock market value, has just hit another record high of well over 200%, which certainly suggests overinflated prices. As a result, it's got media outlets commenting that a stock market crash could be on the cards. And whilst media outlets publish this kind of stuff all the time, year in and year out, it probably is fair to assume currently, on the basis that the S&P 500 has been on a phenomenal run over the last 5 years, providing compounding annual growth rates of 13.5%, which is significantly above the longer-term average of just over 10% over the past 30 years. So given all that, now let's analyse why the markets are still pushing higher, despite some valuation headwinds that are currently present. Here is a chart of the US dollar index. It shows the US dollar has declined in value about 9.5% so far this year. This has a huge effect on both the economy and asset prices, but possibly not in the way that you might think. Let's talk about it in the context of asset prices, because when we overlay the S&P 500, you can see as the dollar has declined, the US stock market has continued to pick up speed, which may seem somewhat counterintuitive, but there are a couple of explanations as to why this is the case. Firstly, when the US dollar weakens, well, US stocks become relatively cheaper for foreign investors. If hypothetically one share of Apple was valued at $100 on the 1st of Jan, as a UK investor, it would have cost me about £80. Now, assuming that that stock price remained unchanged and was still $100 today, with now a more favourable exchange rate, that same single share in Apple would now cost me £73.88. The impact on the FX rate can attract foreign capital inflows into US equities, which very much appears to be the case, especially based on this data which I found from Reuters, where you can see an increase in inflows across both equity markets, which you can see in orange, and money markets, which you can see in purple, especially when we compare the flow of money to earlier on in the year. But that's not the only flow of money that's propping up prices. If we look at M2 money supply, which just think about it as a measurement of all of the money in the US economy, you can see that it's been climbing again since 2022. Reversing the prior dip that we had after the pandemic. This process is referred to as quantitative easing, or perhaps more less formally known as the money printer, and here's why it matters. When central banks pump more money into the system via the purchase of government bonds, this money flows then to banks and financial institutions, which ultimately ends up in the hands of corporations and consumers. Simplistically though, it results in more cash chasing the same number of assets, and when you have that, prices go on to increase. It's kind of like thinking about it in the context of a rising tide lifts all boats. And that doesn't exactly require businesses to do better. It's just purely on the fact that there's more money in circulation. But in fairness, QE has been a contributing factor to inflated asset prices for many, many decades before. And actually, whilst in 2025 it's not a huge theme, it's certainly still a theme nonetheless. Corporate earnings, or earnings per share, has a positive correlation with the performance of the S&P 500. As you can see from this chart, it's very clear that when EPS drops, stock market prices drop too. But when EPS rises, stock market prices also rise. So it's important to stay on top of what corporate earnings are doing quarter by quarter, because that could provide an early indication as to what the future direction of the stock market could be. And as I was scripting this video earlier today, I've read that tech stocks have declined 3.5% due to a report from MIT indicating that 95% of organizations investing in generative AI have seen zero returns. Not exactly the boost in corporate earnings that many investors are perhaps expecting. Regardless of headlines like this, businesses are very much still operating profitably, with or without AI being a core part of their overall business model, as we can see from the latest set of quarterly earnings data, which has been provided by FactSet. This was data that was released 2 weeks ago, and generally S&P 500 earnings are pretty strong for Q2, with year-over-year earnings growth rate of 11.8%. 81% of the companies who also reported have an actual earnings per share above industry estimates. A positive performance and outlook which very much contradicts the recession narrative. Forward P ratios are still above the 5 and 10-year average though, despite these stronger reported earnings. This suggests that market prices are growing at a faster rate than that of corporate earnings, or at least on a longer term average basis anyway. But they're not the only contributing factors towards higher market prices. Tariffs have been a story pretty much since the start of the year. One minute they're wreaking havoc on markets, then Trump agrees to some deals, and then before you know it, the market's up 30% again and it's all largely forgotten. But because of all of this economic uncertainty now, then it's left the US economy in a slightly complex position. Q1 economic growth figures were negative and obviously poor, but then Q2 were more in line with the normal. And as a result, I think that started to shift the sentiment a little bit away from recession fears, which were very much topical at the start of the year. Or at least that's been the shift in sentiment in earnings reports since Q1, with the word recession being used far less. Perhaps that's given the market some confidence and perhaps has also supported market prices moving even higher. So there are many different factors that are continuing to contribute to higher market prices and this asset bubble, if you like. But now let's assess some of the risks that are associated with investing into the market at an absolute peak. And we'll also discuss some of the risk mitigation strategies that can be used to ensure a long-term profitable investment portfolio, even if a market crash were to occur. When stock market prices are at all-time highs, the risk of a pullback naturally feels greater. And one of the ways that we can assess this is through something called a price-to-earnings ratio, which compares the price to company earnings. Now, right now, the S&P 500's price-to-earnings ratio is sitting at one of the highest levels in the past 25 years. And every time that we've been here before, in 2000, 2008, and even 2020, the market eventually corrected. So yes, valuations are certainly a risk right now, but risk isn't always a bad thing, especially if there is a strategy in order to be able to better manage it. And one of the ways to psychologically better manage it is to also understand what's happened in the past, even if past performance isn't necessarily indicative of future results. One thing that's important to know is that market corrections of 10% or more, or even bear markets of 20% or more, are perfectly normal. Since I started investing back in 2017, there have been 14 market corrections. That's roughly twice a year the value of my investments have fell 10% or more. A market crash, however, well, these are a little bit more infrequent, and I've only actually experienced one of these as my time as an investor back in 2020. But since the 1950s, these bigger market crashes have occurred 13 times, or about once every 5.75 years. Time and time again, we see these perfectly normal market crashes, and despite what can feel like long periods of time of market underperformance and even negative performance, sometimes even lasting a decade or so, what you can see is if you look at a chart across a long enough time horizon, well, markets have always recovered, at least in the context of the US stock market, and that's a perspective that I always try to maintain as a long-term investor. But when everything is crashing down, how on earth do we protect our money and come out unscathed when it's all said and done? There's been lots of talk about the future performance of the US stock market and the potential underperformance over the next decade or so. Whilst I'm not a huge believer in looking too closely at future stock market outlooks, Vanguard have published some research on what they believe will be the 10-year annualized performance of the US equity market, which they've concluded will be about 3.9% per year. Now, of course, that makes for some uneasy reading and certainly shows that past performance isn't necessarily indicative of future results when we look at those longer term averages for US stock market performance, It's even led to some investors calling out a lost decade for US stock returns. But even if we did see a lost decade in terms of performance altogether, positive performance can still be achieved through navigating the stock market through regularly cost averaging into it. Let me explain exactly what I mean. To do this, I'm going to use the actual lost decade and a little bit between the years 2000 and 2013. If an investor invested £500 a month every month during that period of time, regardless of P ratios, markets melting down, and catastrophic failures, that individual would have invested £78,500 during that period in total. But they would have come out with £113,165. Now that's not a huge return over 13 years, it's 5.4% in nominal returns per year, but it does still show the power of consistently investing over a prolonged period of time. Because if an investor buys into the market as it falls, they'll benefit from lower market prices, and then they'll benefit again when the market goes on to recover. Now if I'd achieved that kind of rate of return after navigating two of the worst stock market crashes in stock market history, well, I think I'd be pretty satisfied with my overall performance. But in order to be able to do this, there is one trap that investors must absolutely avoid. When markets are fluctuating, it can be enticing to trade the market based on research that you've done, or perhaps even just a hunch that you have about the market that you think something bad could just be around the corner. But as Peter Lynch once said, more money has been lost waiting for corrections than in them. And look, for those looking to time the market, well, it can be absolutely catastrophic for long-term investment performance. Research conducted by JP Morgan shows what happens to a single $10,000 investment made in 2000 up until the year 2023. In the S&P 500. And it shows if an investor remained fully invested, they would have achieved returns of about 9.7% per year and acquired $63,637. But if they'd missed the best 10 days, well, those returns dropped to just 5.5%. Missed the best 30 days, and well, the returns are barely above break even at just 0.7% per year. This emphasizes the importance of staying invested into the market and not dipping in and out of it based on different market cycles. Now, when does this market crash then occur? Well, the answer is nobody truly knows. It could be many, many more years into the future before it takes place. Or it could be tomorrow. But it's impossible to say and impossible to predict. But hopefully you can take some lessons away from this video to be prepared for what historically has been absolutely inevitable. So if you did enjoy this video, be sure to subscribe to the channel. And if you want to see what I'm doing with my own investment portfolio right now, then be sure to click on this video next. With that being said, see you over in the next one.